Welcome back to SMSF Mate's daily podcast. This is our general advice warning that we are required to warn you that any advice has been prepared without taking into account your objectives, financial situations or needs, and because of that, you should, before acting on the advice, consider the appropriateness of the advice having regard to your own objectives, financial services and needs, and where the advice relates to the acquisition or possible acquisition of a financial product, you should obtain a product disclosure statement, PDS, relating to the product and consider the PDS before making any decision about whether to acquire the product. Now let's get into it. Hello and welcome to today's SMSF Mate podcast. Today we are going to be talking about the word wrap. It is not something you get at a fast food restaurant. And my name is Gareth, and with me I have
Ashwin
and Sonny.
So what is a wrap?
And Tim, whose mic's not working.
Yeah, and Tim's mic's not working. So wraps for lunch?
Investment platform. So it's basically a electronic web-based platform that can consolidate investment and reporting.
Do I need a wrap?
If you want to access particular investments that have minimum investable amounts, so if you're thinking about, it's a good example, a direct share investment on the ASX. In order to buy and sell, you need a trading account.
Right, one of those.
Yeah, one of those. In order to then buy unlisted managed funds.
Unlisted managed funds, right.
You need a platform or a wrap account to be able to buy and sell and transact.
Right.
So,
and where do I get a wrap account?
From a wrap provider. So there's a number of companies out there. Typically, the retail market accesses wraps or investment platforms through financial advisors. So it's
so I'm the individual, the investor. I go to a financial advisor. They then have access to wrap products.
Correct. So, for example, historically we've used a particular wrap service by a large name bank, who then has 3,000 different plus unlisted managed funds and products on the wrap.
Right, that I couldn't get.
That you couldn't
normally
get, or people off the street maybe couldn't get because the minimum investment into those funds are too prohibitive. For example, a minimum investment might be $1 million into a fund. Right. What the wrap does is effectively consolidate investment from a number of investors to hit those levels that then allow investment in the fund.
Right. Interesting. So, yeah, if I fire up my share trading platform account with my major bank, I would not be able to find that product in that place.
Correct.
Right.
So think about it, it's a trading account
that's
for
a wrap.
Unlisted managed funds predominantly.
Right. And does the wrap stand for anything? Is it an acronym for something, or is it just a code name?
I don't know in short. I've always approached it as a wrap, as in it wraps and consolidates
right, like a big bucket, basically.
Yeah.
Right. So if I go to my financial advisor and say, I'd like a wrap, please, is that the right terminology? Or
investment platform, wrap platform.
Right. So I've heard about these things called wrap. Can you tell me what sort of products we can get access to if we go through a wrap? Yeah. That's the lingo.
And Ashwin probably better to talk about this, but there's the advent of newer platforms and wraps now that are more, business to consumer than they are business to business, in terms of not from a bank to a financial advisor, but a bank or a business to now a direct consumer.
Yeah. So it's not an ETF.
No.
They're unlisted funds, but you'll find some of the new platforms which might have traditionally lower fees. Have traditionally lower fees, don't have access to those things. So you still probably need to touch base with an advisor to have opportunities. Given to you through that space.
So for example, if I used an ETF, which you can buy and sell on the stock market, to get access to an oil fund, a wrap in the same kind of way as how an ETF works allows a financial advisor to put together a number of investors together to then buy a stake in an oil fund, kind of.
Yeah, I think the
analogy is kind of there.
Really
different
that
purpose.
Along the way in different senses. To simplify, if you think about a trading account, you can only buy typically listed investments. Listed
being on the stock market.
That's right.
Yep.
On a wrap account or investment platform, you can buy and trade listed investments
So
and
stocks and shares.
correct, and unlisted investments, which are predominantly unlisted managed funds.
Example.
So
I own $10 million worth of property in Osborne Park in Perth, and that could be a fund that would be unlisted that I could get through a wrap, in theory.
if you then went through the process of getting your fund
Right.
onto the platform, licensed and structured in the appropriate way for it then to be distributed via the platform and wraps.
Yeah, understood.
So platform and wrap, let's use that interchangeably. So not all unlisted managed funds are going to be available on wraps, either by scale, size, investment mandate, being approved by the wrap or investment platform provider. So all of that needs to happen before. In a previous podcast, we talked about managed funds that might be wholesale. There's a lot of wholesale managed funds that are in the early stages that won't go through the process for size, rigmarole, compliance to get onto a wrap. Because if a wrap provides additional distribution to retail and wholesale investors.
Would another hurdle potentially be that let's say, that product is approved by the wrap that you're part of, it might not be part of your product listing as well?
Correct. So each, even though I mentioned a particular bank's investment platform has access to over 3,000 different unlisted managed funds, the advisors who are out client-facing, providing advice and making investment recommendations may have a limited subset of what's approved on their approved product list in order to recommend those investments to particular clients.
Right. So, you take your 3,000 bucket, but only 500 of those 3,000 are going to be available.
Yeah, it might be less than that. It might be 10,
typically
might
it's
be
a lot
5.
less. Yeah.
So
Right. And then the financial advisor then may have their preference and say, well, now I only want these 5. Yeah. So what you're effectively saying is there are a lot more investment opportunities that exist that you may not see on the outside view.
Yes.
Yep.
Right.
How are you charged as an investor of a product on a wrap? How do I pay fees and how does that work itself out?
Okay. On wraps or the investment platforms themselves, there's something called administration fees. So they're the fees that the wrap provider charges in order to administer and provide access to the magnitude of investments on their product list, effectively.
And what sort of fees are you looking at?
It ranges based on the platform. So you can have fees that are negligible. We're talking, low
Cents in the dollar type thing?
Yeah, or low percentage points or basis points. You might get admin fees that are fixed dollar amounts on certain accounts as well, which might be a flat dollar amount. You get admin fees that are charged, as a percentage, for example, a scaled fee for up to, 50 basis points, as an example. So 0.5 of the value of your investment gets charged as an administration fee for holding it on the wrap.
Right.
So that a wrap allows you and provides you access to trade those unlisted investments, and it also provides you the ability to report and consolidate reporting. It also does the tax reporting, which is relevant for people that run self-managed super funds. There's a lot of self-managed super funds that use wraps.
Yeah, that's a good question.
Because you can do consolidated reporting and tax reporting on all the investments, so you could have a portfolio of, how many of your 50 plus unlisted managed funds in your self-managed super fund.
Yeah. So I guess to qualify as a product on a wrap, there is quite a high hurdle to be approved. Would that be true? You have to go through a lot of compliance and.
if you need a big bank or a big institution to check you out, I think there would be a fair level of compliance required. And then you probably also have to go through the advisors who will select certain ones they want on or could have on their product listing, depending on the fees and exposure and other things like that. So it'd be fairly hard to get through all of those processes. There's no guarantee, but I would say that when you're looking at this sort of stuff, my personal view is you'd find an independent advisor. So someone that's not lined up with an institution where maybe the way they've streamlined the process to get on the product listing is it's already gone through their institution or it's part of their institution. When maybe you want a holistic view and get someone that's actually checking more detailed view over those 3,000 approved products. So that's the way I would look at it. So
I wouldn't. I'll preface by saying that I wouldn't say that unlisted managed funds on a platform are particularly any better than unlisted managed funds that aren't, right? But there are hurdles, compliance, cost, size and inflow of investment. There's benchmarking, there's ratings required, typically to get onto a platform. Once a fund manager's on a platform, it opens up broader distribution opportunities to not only to additional wholesale clients but retail clients as well. And a little bit like we've talked in the previous podcast around retail and wholesale, there's an additional overlay of compliance and checks and balances when you're on a wrap as well. But again, just because that's there, it doesn't mean that the underlying performance or investment thesis of the fund manager is any better than a fund that's not on a wrap platform.
Yeah, because in my experience in that distribution space, working for young funds or listed funds or whatever, it's often the case where, the manager thinks, okay, we'll try and raise a certain amount of money, perform really well for 5 years, and then hopefully we can apply to become a wrap product, and then the salespeople's jobs become a lot easier, pretty much.
I think that's a key point. That distribution really opens up. If you think about a fund manager who will try and distribute their product not on a wrap, they've got to do that directly. So they're going fund to investor. Once you're on a wrap, because of that wrap aggregates a whole lot of investment and investors and are used by typically a lot of advisors, there's a consolidation of a huge distribution channel.
So in theory, it's more efficient, which usually means it's more cost effective.
Yeah. Well, to your point, Sonny, we used to do seminars to SMSF trustees. We might have 100 people in a room, and they would all be wholesale investors. And the minimum investment in this particular fund was $1 million. So you get a couple, and that's great.
Right.
But on the flip side, if you're on a wrap, you might just receive an allocation from an advisor or a group, and that allocation could be
$100 million.
Exactly.
Right.
Yeah, and you go, oh, sweet.
Job done.
Yeah.
No need to take out a function centre and put on food and drinks.
Exactly. No catering.
And answer stupid questions.
Which is important for fund managers too, so they can spend their time focusing on managing the investment rather than out
trying to get
distribution and selling.
Yeah.
But to your point earlier, Ashwin, there's also strategies that have constraints around size and ability.
Sounds like wraps are good.
Wraps are good. Got to be mindful as well. There's a lot of advisors that will just put clients into a wrap, and we're focused on self-managed super funds here, right? So they might put a client into a wrap to get particular distribution, and that wrap might be paying higher admin fees than other options, or that it should.
Right.
And that might be because it's the only one available to that that particular advice group. There's broader wrap products out there, and there's a highly competitive space now in terms of administration fees for wrap platforms. But getting into another conversation and maybe a different time for a different podcast, you asked what are the fees. The other fees, Tim, are obviously then the management expense ratios paid to the investment managers or the fund managers and the products that you've actually invested in via those wraps. So two key costs is obviously the admin fees to access and report on those investments, and the other fee is the management expense fee paid to the investment manager to actually manage the investment.
I suppose another good point of contact is the site actually has a list of investments.
You mean the SMSFmate.com.au website?
That's a good plug there, Gareth. Yeah, so we put together an information piece. Users of the internet should go back and obviously do more research than what we've put together, because we've just compiled what we got access to. But you can see performances, you can see sectors, you can see management fees, you can see the costs involved in an overview per view, and then maybe engage an advisor to make sure it's...
The important thing about fees as well, though, you've got to think about the combination of those admin fees and the management expense ratios as a whole. Always look out for the disclosure of management expense ratios or fees, because they're typically not cash flowed or paid by the investor, and they're embedded in and reflected in the unit price of the fund itself when you're buying and selling, whereas administration fees on platforms are cash flowed or paid by the investor using the platform. Right. Yep. So you'll see a dollar amount physically going out of your bank account for an admin fee, but a management expense ratio
can just be taken out of the unit price.
Yep. Correct.
There's also performance fees
hidden
and other
fees basically.
Well, and there's a lot of challenges in the past in the industry around disclosure of those fees, which is it's a lot more regulated now, but we always encourage people to look at fees from a perspective of what's cash flowed and what's not cash flowed, and look at the the total combination of those. There's also a theory that the management expense ratios don't matter as much so long as the performance is there. Yep. So would you rather a 10% performance with a 5% fee, or a 4% performance with half a percent fee?
Yeah. Yep. All relative, right?
It's all relative.
And I suppose the easiest way for any investor to get clarification is you engage the provider or the advisor and ask the question, what are the total fees to invest in this product? And they will disclose all the information available to you before you invest. So it's important to ask that question, because...
And they're required to by law.
Yes. So, that's the whole purpose of financial advisors in the space, is to give clarity to investors.
Thank you for joining us once again. If you're interested in our waffle about self-managed super funds, feel free to join us on smsfmate.com.au or search SMSF Mate in Spotify.